The live intraday price for SoFi Technologies Inc., trading under the ticker SoFi on the Nasdaq, is currently sitting at $28.39, reflecting a slight dip of minus 0.17% in today's session as of the late morning hours on this Thursday, September 25, 2025. This very slight cooling off is interesting because the broader market narrative around SoFi has, for the better part of the last year, been overwhelmingly bullish, predicated on its consistent and accelerating march toward profitability and its unique vertically integrated financial tech ecosystem. The expectation is often for SoFi stock to simply track upwards on the back of its incredible user growth and successful bank charter transition. Yet today's gentle downward pressure suggests a more complex reality lurking beneath the surface, one tied closely to macroeconomic pressures and the constant scrutiny on lending-heavy fintechs. The real story here isn't the marginal movement today, but the fact that this stock is consolidating near its 52-week high, a level it recently tagged after climbing over 270% from its 52-week low. This consolidation suggests the market is pausing to ask a critical question. Is the premium now priced in for execution, or is there still significant hidden value in their Galileo and Technesis platforms, which represent the true differentiator for SoFi beyond consumer lending? Most investors are focused squarely on the consumer segment, student loans, personal loans, and the SoFi Invest platform that competes with places like Robinhood and Fidelity. But the underlying technology stack that powers not only SoFi but many other financial institutions is where the long-term high-margin capital-light growth may actually reside, and that side of the business does not get nearly the airtime it deserves in the daily trading commentary. This subtle tension between the heavily watched consumer business and the quiet, high-growth tech platform is the core of what makes SoFi stock so compelling and volatile. Today's trading volume is a bit below the average, which is typical for a slight down day following a period of strong upward momentum and price discovery. What we are seeing is likely profit-taking by short-term traders who capitalized on the recent run-up, especially after the latest positive earnings report. Recall the immense positive reaction to the recent Q2 2025 earnings, where the company reported its second consecutive quarter of GAAP net income, significantly accelerating net revenue growth to a record $855 million, an impressive beat on both top and bottom lines. This momentum confirms the market's expectation that SoFi has finally flipped the switch to profitable operations, a huge psychological hurdle for any fintech. Yet the price action immediately following that report saw a significant spike followed by a pullback. This is the expectation versus reality principle in action. The expectation was that profitability would immediately launch the stock far higher, but the reality is that good news is often a catalyst for short-term selling by those who bought in anticipation of the news. Institutional activity has been net positive, with major players like Vanguard and BlackRock increasing their holdings, which provides a strong bedrock of confidence. However, a closer look at the 13F filings also reveals some large hedge funds trimming positions, which is typical rebalancing behavior when a stock approaches its high. This back and forth between long-term institutional accumulation and tactical profit-taking is what keeps the trading range tight right now. The stock is essentially battling a psychological resistance level around the $30 mark, which has become a magnet for sellers. The broader sector momentum is a factor we cannot ignore. The financial sector, and specifically the fintech space, remains highly sensitive to interest rate policy and macroeconomic stability. As a major player in personal loans and, historically, student loan refinancing, SoFi Invest's core lending business is intrinsically tied to the cost of investment money. When the Federal Reserve signals a higher-for-longer rate environment, the market gets jittery about loan origination volume and credit quality, despite SoFi's stated focus on high-earning, high-credit quality customers, its Henrys. This macro headwind provides a solid investment help narrative for the bears, who argue that the stock is now too richly valued for a company with relatively thin GAAP margins, especially compared to established players like Fidelity Investments or Interactive Brokers. But that's where the contrarian take comes in. The bank charter is the key de-risking factor. Unlike non-bank fintechs like Robinhood, the bank charter allows SoFi to fund its loans with low-cost member deposits, significantly reducing its reliance on more expensive wholesale funding markets. This structural advantage insulates them far better from rate hikes than the market generally acknowledges, suggesting the skepticism is perhaps a little overdone. The market is viewing SoFi as a high-growth lender when it should be increasingly viewed as a high-growth, vertically integrated tech-enabled bank. Let's break down the company's business structure, which is vital to understanding the SoFi stock story. The company operates on a triple play model: the lending segment, the financial services segment, and the technology platform segment. The lending segment, while responsible for the bulk of revenue, is the capital-intensive and rate-sensitive part, encompassing personal loans, student loans, and home loans. The financial services segment includes the checking and savings accounts, credit cards, and the SoFi Invest brokerage that competes with places like Robinhood and Fidelity. This segment is all about driving member growth and deepening product penetration. The real engine of competitive differentiation, however, is the technology platform, which includes Galileo and Technesis. Galileo is a core processing platform that enables other non-financial companies to offer their own branded financial products. Think of it as the plumbing for the next generation of fintechs. This segment is high-margin, capital-light, and grows incredibly fast. It's what justifies a technology-like multiple for the stock rather than a typical bank multiple. The recent growth in this segment has exceeded expectations, showing increasing traction with new clients looking to build out their own financial offerings, reinforcing the stickiness of SoFi's overall ecosystem. For any of you using Schwab Intelligent Portfolios or any similar intelligent portfolio offering, you're interacting with the kind of digital backbone that SoFi's technology platforms are designed to compete with or even power in the future. The company's strategy of cross-selling is also a major driver of the stickiness everyone talks about. The average SoFi member now holds nearly 2 products, a figure that is steadily climbing, indicating the integrated approach is working to convert single-product users into multi-product, high lifetime value clients, making the overall business model much more robust and predictable. This is a critical factor for sustained profitability, moving the company away from relying solely on new member acquisition toward maximizing value from its existing base, a more mature and stable business trend. The sheer scale of the member growth is also noteworthy. They've consistently added hundreds of thousands of new members and millions of new products quarter over quarter, a pace that few competitors in the space, outside of perhaps Robinhood, can match. However, the quality of that growth, particularly the shift toward more deposits and less reliance on wholesale funding since acquiring the bank charter, is what separates SoFi from its peers. The cost of funding is a silent killer for many lenders, and the bank charter gives SoFi a structural, long-term advantage in managing that cost. From a technical perspective, the recent trading action suggests a period of consolidation. The stock's Relative Strength Index, RSI, is pulling back from overbought territory after the last surge, which is healthy. A short-term support level has been established just below the current price, but the major test of commitment will be the 20-day moving average, which is now rising to meet the current price. A solid bounce off that line would signal a continuation of the upward trend driven by long-term holders. A break below it, however, could indicate a deeper pullback as profit takers take more off the table. Given the high short interest the stock has historically carried, any unexpected positive news or another significant earnings beat could trigger a sizable short squeeze, pushing the stock quickly past its recent high. The high beta nature of SoFi stock, meaning it tends to move more dramatically than the broader market, is why it is attractive to many active traders who use platforms like those offered by Interactive Brokers for its comprehensive trading tools. The future outlook for SoFi Technologies Inc. hinges primarily on 2 major catalysts. The first is the student loan payment moratorium finally ending. While the market has priced this in to some degree, the reality of a massive one-time influx of high-quality refinance business flowing back into their core origination engine could still exceed expectations. The second is the continued scaling of the technology platform. If Galileo can secure a deal with another top-tier financial or non-financial institution that is looking to embed banking services, a fintech-as-a-service contract, it would be a major positive catalyst. The market currently undervalues this segment, seeing it as secondary to the lending side. A marquee customer announcement would quickly shift the narrative and justify a higher valuation multiple. The risk, of course, remains credit quality. In a prolonged economic slowdown, even the highly vetted Henry customer base is not immune to job loss or financial stress. Any significant uptick in charge-offs or loan loss provisions would be a major detractor and challenge the current growth narrative. The management team, under CEO Anthony Noto, has consistently beaten guidance and shown a prudent approach to underwriting, which is a major reason for the stock's recent strength. This track record suggests a higher probability of successful execution than what the current consensus, a general hold rating from many analysts, might imply. This is why it is so important to look beyond simple analyst ratings and truly understand the components of the business and the quality of the management. The path forward for SoFi stock is essentially a story of proving that the bank charter was the ultimate turning point, transitioning the company from a speculative loss-making fintech to a sustainable, profitable financial holding company with a powerful tech backbone. The expectation is growth, but the reality must be margin expansion, continued GAAP profitability, and a demonstrable acceleration in the capital-light technology platform segment. If the company delivers on all three fronts, the stock has substantial room to grow beyond its current highs. The narrative that is underappreciated is the network effect created by the ecosystem. Every new product makes the whole platform stronger.